You were listening to chartingwealth.com for Friday, the 20th of May, 2016. The charts are moving in the directions we have been talking about. How about it? Those of you who got into a short move, do you not love the way the market was looking for you today? Nice down movements on all three of our major indexes. Gold was also down. Let's talk about what's going on. Well, IYY. Our two-day chart, IYY, is the iShares Dow Jones U.S. Total Market Index Fund. It represents the entire stock market and what's going on. It helps us get a good feel for the overall market mentality, and it is down. We have a big down candle for the 19th, the first day of that two-day candle. It's going to wrap itself up at the end of the week. That is on the 20th. It will close out. It is currently a big down candle, the biggest down candle we have had since probably, in a while. Got close to the size of the down candle on the 4th of May. Looks like it's probably, well, almost exactly the same size, maybe a little bit bigger, but of course it's also followed by big down moves in the MACD as it diverges, moves away from the signal line, plus an increase in the down movement on the derivative oscillator. So we have a downtrending market at this point, particularly after the Fed's announcement on Wednesday that they're looking at a rate hike perhaps in June. Now, don't hold your breath for that actually happening. It could. If you think the economy's doing great and they need to put the brakes on it, well, we shall see. Talking's one thing, doing is another, and even if they do anything, it may very well be slight, if anything. So we shall see, but again, it's the sentiments that we're paying attention to. So if we look at the 4-hour chart, how did that down move of 0.5% for the day play out? Lots of down movement in the morning on Thursday the 19th, some up movement in the afternoon. As I look at these charts, make sure that you check out the latest training we've just put up online. It is actually available for you if you haven't already signed up for our newsletter. You need to go to chartingwealth.com and sign up for it. We send out all of our trainings and our daily reviews and weekly review and forecast to everybody who receives that. You can also, of course, subscribe to us on iTunes at both of our different iTunes podcasts. We have a video podcast that we do every week. That's the weekly review and forecast, and of course our daily audio. That also includes the audio of the weekly. So whichever. But please be aware we do have a great Hinkin Ashi candlestick training that we just did and just made available for you online. First people to get it are always our subscribers. Now, we see that there was some up move in the afternoon. Again, crossed over going down back on the afternoon of the 17th of May. So let's now move on to the 2-hour chart on the SPY, which is the S&P 500, down 0.34% for the day. We have a nice size, and again, yes, on the S&P 500, that is the biggest down two-day candle in quite a while. It's not closed out yet. It could roll up some on us, but as it ended up on the day on, and this is again a two-day candle, as it ended up at the end of the day on Thursday, the first day of the 2 days, big down candle below the two-day trend line that is continuing to hold out as a nice trend line for us. Derivative oscillator heated up, and the MACD and the signal line are diverging quite a bit. So if we look at the 4-hour or half-day intraday chart, what do we see going on? Similar to the total market, lots of down movement in the morning, and then some up movement in the afternoon to shave off all that total down movement. So again, the S&P 500 down 0.34%. Hopefully you got into some of the action when we had the initial crossover going down on the 4-hour chart on the 17th. Now people do ask, how do I know when to get in? The way that you know when to get in is when you have, again, that rollback after the new movement, and in this case, the down movement on the big chart that took place. When that took place originally, again, a quick little lesson, we saw a crossover going down back on the 28th of April. That is when we had a confirmed reversal of trends from the prior uptrend to the downtrend. That happened on the 28th of April. At that point, when we go from the 28th of April on our 2-day chart to our 4-hour chart, we start looking for a backup on that chart. Now, on the 28th, the market kept going down until there was a backup starting that crossover on the morning of the 5th of May. At that point, we had a backup, and we're waiting for the market to turn back over going down. It did briefly on the 13th, so your entry point was possibly in the afternoon on the 13th, or actually more likely on the morning of the, wait, I think I said yes, the morning of the 13th, the afternoon of the 13th, or the morning more likely of the 16th. And again, you only have a confirmed down move, you only have a confirmed crossover when the candle closes. And again, it would have been hard to do that right at the end of the day, seeing that it closed at the end of the day. It would have been easier to have gotten in sometime on the morning of the 16th. So and what happened? Well, immediately it turned over and went back up, didn't it? Well, you wouldn't have gotten in on the afternoon of the 16th. You might have gotten a little panicky because the market actually turned right around, but should have felt better because it never closed above the 2-day trend line. Even if you jumped in that morning, what happened over the next few days? Well, on the 17th, the market actually rotated back over, and you saw on the morning of the 18th that it had already crossed back over going down. Actually, it ended the day. So you could have gotten in end of the day on the 17th or the morning of the 18th. And why? Well, because we had the backup occur and we found two separate entry points. Doesn't usually pop right back over, but again, it did. And so you had two entry points, either on the 17th or on the 13th or the 16th, morning of the 16th. And then what happened? Well, the market then continued its big downslide, paralleling what? Paralleling, of course, the already continuing trend on the big chart. The big chart leads the way. We don't just jump in, though, at any point. We wait for a backup, and then we jump in when that backup is over, and the market keeps going down on the short chart. Now, you might say, does it always do that? It doesn't. Sometimes there's no backup. Sometimes the trend ends quickly and it goes back in the opposite direction on the big chart. Well, then you have no trade there. We are trend following. That is our trick and our key. Now, lastly, let's go back to our charts as we'll finish up on this index and then go to gold. We're finishing up on index-wise on the Qs. That is the Nasdaq 100 rotated over back on the 26th. Both the crossover going down and the derivative oscillator crossed on the 26th of April, and the market trudged down markedly for several days and then sort of flattened out. Now, it was down 0.52% over the course of the day. If we look at, that is on Thursday, if we look at the 4-hour chart, we see that there was a crossover in the morning, and you could have had a buy-in point in the morning or in the afternoon on the Nasdaq 100 when it crossed over going down. And again, whenever we talk about crossovers getting close, and we saw it getting close for several days, just now made it. When you know that's happening, it's worth checking the markets around noon and again late in the afternoon. Don't have to do it but twice during the day. You don't sit there and watch all day long, but one or two times. Find a good point where the crossover occurs and then do your virtual purchase. Now, when I say virtual, I'm talking about you using virtual funds. We're not a stock calling service. We're not giving you investment advice. We're giving you ideas about practicing your own investing and trading with virtual money. And we have more to say about that at the website. And also, I'm just finishing up our latest book, so we can't wait to launch that to you in the near future. So that is where we are on the Qs. It's always nice to see the markets move in the direction that we predicted they would, that we saw coming. Those of you who join us every day, you've heard us talking about it for many days, and we see it develop. It's not rocket science. It's stock chart reading. It's been a long day. Okay, now we're going to go back to the 2-day chart. And we're going to check out gold lastly. Gold was down 0.21% for the day. Gold crossed over back on the 18th, going down on the 2-day chart. And of course, big plunge in gold as far as the candle goes for the first day of the 2-day candle on the 19th. After that crossover on the candle on the 18th. So we had the derivative oscillator and we had the MACD crossover going down on the 2-day chart on gold at about the same time. Let's look and see what's going on the 4-hour chart. Talked about this a couple of days ago. Crossover occurred because gold plunged pretty markedly back on the 18th. It is difficult to jump into a market when both the MACDs on the large chart and the short chart, that is the 2-day and the 4-hour chart, happen at the same time. Typically, the best thing to do is let them both go over together, wait for that pullback on the short chart, and then see if there's an ability to jump in on that down move later. It's the safest way to go. And it's because the last thing you want to do is jump in on a huge plunge and then see the stock recover. It's easier to wait for a pullback on the short chart and then it moving back over and giving you an entry point at that point. Again, all we're trying to do is first preserve our capital, not lose money. Second, make money. The beautiful thing about being the kind of investor or trader that we're trying to become by learning to read these stock charts is we're not like the professional traders on Wall Street. I think we're professional in our attitudes and our acting, but we don't have to trade every day. Many of them have to do something. We don't. We wait until the time is right and the charts are ripe. The time is right. The charts are ripe, R-I-P-E. Thank you so much for being with us. We appreciate it. We love to hear from you. Follow us on Facebook, Twitter, Instagram, YouTube. If you're not already signed up for our daily podcast, our daily email, the weekly review and forecast, you need to do that. You can do that at chartingwealth.com. We love to hear from you. We also love you to go to iTunes and give us a 5-star rating. So many of you have. We've also gotten ourselves rated in the last week on the new and noteworthy for the video podcast that we do on the weekly review. Thank you guys. You're so good to us. We are happy to try to help you out. Please be good to us too. God bless. Take care from Charting Wealth.